Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is once again your monthly market update with Rick Rule, and we have a fancy new intro that you probably just saw we're really proud of. Thank you everybody for joining us, and Rick, of course, thank you for joining us.
Thank you, Colin. It's a pleasure.
I want to talk to you about some of the different financings that are going on in this market. We put a piece out a couple weeks ago examining how many streaming deals there were in 2015. There were quite a few as opposed to 2014. And I want to ask you, from an investor standpoint, is this a creative way for mining companies to bolster their treasury, or are you seeing them simply selling their futures away?
I think depending on the deal, both things are occurring. I think the arbitrage that's occurring right now between the biggest of the streamers and the large base metals companies is accretive to both parties. We've talked about this before, Colin, but the precious metals byproduct streams on base metals mines present a tremendous arbitrage in the market. Those streams are being valued at about 15 times EBITDA in the market caps of the streaming companies, at the same time that cash flow in base metals mining companies attracts a 6 or 7 times EBITDA multiple in markets. So you have seen several $1 billion worth of transactions, and it wouldn't surprise me to see another $10 or $12 billion worth of transactions taking place otherwise. On the other hand, the precious metal streams that are being used as a component in construction finance by some of the precious metals mining companies are clearly dilutive relative to the terms that they could get in the market. So I don't think that you can answer the question easily. One needs to look at the nature of the transaction that's taking place.
And Rick, keeping to the alternative financing theme, quite a few strategic and financial investors are stepping up to the plate. Most notably, I saw CGN Mining announce an $82 million injection into Fission last week. And that brings up an interesting question because that's a Chinese-backed group. With China's economy slowing, do you see that affecting negatively the commodities industry worse than it already has been so far?
Well, I think you asked me two different questions there. I do think the slowdown in the Chinese economy has certainly impacted commodity demand, and as a consequence of that, commodity cash flow. In terms of capital available in the mining business, there are literally billions of dollars of capital looking for the right projects, looking for the right deal. And the Fission deal was illustrative, I think, of what will happen with the best of the best projects. The best of the best projects will not want for money, as the Fission deal showed. A parastatal, particularly a parastatal that's looking for access to commodities, has a much longer view than today's equity markets investor, particularly institutional equity market investor, who are experiencing outflows from their funds. And it's interesting to see a deal that can be 30 or 40% accretive in the market to the buyer, while at the same time in the longer term the buyer is getting a good deal. It is not true that there is a shortage of capital in either debt or equity markets with regards to the mining business. What is true is that the mining industry has come to be reliant on dumb money, and most of that dumb money's gone, but there's lots of smart money around.
Okay, and since we were talking about Fission, I want to get to uranium, which we've talked about several times in the past. And I know, and our listeners know, your fundamental approach being that the production costs currently far exceed the going rate for uranium on a per pound basis, and that ultimately must resolve itself. But in the more near term, do you have anything that you're seeing playing out in the uranium space? I believe you're going to be giving a discussion about uranium at the upcoming roundup. I'm not sure if that was public knowledge, but anything there?
You know, the near-term outlook for all things energy is bleak. Not since the early part of the decade of the 1980s, that 1980s interest rate recession, have I seen global demand for commodities so bad. A lot is made of resource oversupply, but it's really resource oversupply in the context of demand undersupply. As an example, with regards to uranium, what you need in the near term to kickstart the uranium business is a restart of the Japanese nuclear fleet. And this will occur, but it won't occur quickly because the Japanese need to restart their nuclear fleet has been reduced by a 60 or 65% decline in the price of seaborne liquefied natural gas, their alternative fuel. So yes, the Japanese will restart. No, they won't restart anytime soon. And the consequence of that is that uranium prices can stay soft until real supply destruction hits the uranium market, or until the new builds, particularly the Chinese new builds, overcome the softness engendered by the Japanese shutdown.
Okay, and on the point of uranium, for investors looking to participate in a potential upcoming uranium bull, we just discussed fission, and if you don't want to point out particular names, that's okay. But maybe you can just tell us what level of the uranium company makes sense for you. You have Cameco at the top, which is an actual cash flowing producer, and there's some developers, which you could throw Denison and Fission maybe in that group, and then just the pure exploratory companies. What, at this point, with the market the way it is most interesting to you?
Well, I think the simplest way for most people to start, if they think the uranium price is going to go up, which I do, is to buy the uranium itself, or the proxy, which is Uranium Participation Corp, of course, on the Toronto Stock Exchange. Your viewer shouldn't confuse this with a recommendation, which would require my knowing their individual circumstance. But certainly an investor who had a year or two to watch what I consider to be the inevitable unfold, and who believed that the uranium price was going to rise, would want to follow it up by buying uranium itself. The second place to be, of course, for that same investor would be Cameco. One of the interesting things about the last move in uranium is that although the juniors moved the furthest, Cameco moved the first. And I would expect the rebound this time to work the same way. Uranium moves, then Cameco moves, then the rest of the market moves. And for investors who are fairly risk averse, which is most after a 4-year bear market, the order of magnitude in the move that you can get from Cameco may well be a penny stock move. There's a certain school of thought that says if you can make 300 or 400% with the best in the business, why take the risk in the worst? Now, the market is doing a very good job of thinning out the rest so that one's choices among the secondary sector are getting smaller and smaller. It's easy to look to names like NextGen, which is, of course, enjoying success, and Fission. And for speculators, those names are worth looking at. My friend Steve Sugarroot has an interesting observation with regards to resources, an observation that sadly I haven't elected to pay too much attention to over the last 30 years. It's find a sector that's cheap. That's uranium. Find a sector that is completely unloved. Boy, is that uranium. But then wait for that sector to technically be in the beginnings of an upturn. That may not be uranium. So yes, the thesis is 100% intact. Investors should consult themselves probably with regards to the timing.
Okay, thank you for that. And I have what's maybe a difficult question, but probably more so an ignorant question on my part. With so much potential leverage in the uranium equity market, why would one want to isolate themselves to just a commodity price move? Because uranium stocks are arguably the most volatile of the commodities. There are so few proxies via public companies to invest in that when I've seen them move in the past, they've really moved a lot. Just wondering where the Uranium Participation Corp would fit into the portfolio.
I suspect that a classic resource investor, understanding that the commodity moves before the equity, would go into Uranium Participation Corp first to limit his or her downside. And then as the uranium price market started to move, would transition from the material to the more leveraged bets. Remember, Colin, that leverage works both ways. Leverage is a lot of fun when it's working for you. But as over-leveraged homeowners found out in 2008, it can be truly ugly when it works against you. And that same thing is true, certainly with regards to microcapitalization natural resource stocks, including those in uranium. It's a lot of fun when the trend is your friend. But when the trend goes against you, it can be messy indeed, as many have learned.
Note well taken on that, Rick. I want to ask finally about the gold stocks, and we're recording this on Tuesday, January 19th. Kind of an interesting day in the market today for me, in that gold is about flat, and yet you have an absolute crushing blow in the gold stocks with the HUI down 6.5% right now. It looks like it's going to close pretty badly. Have you seen this sort of thing happen near a bottom before, or is it just another a blip today? It doesn't really matter.
I think this is technically driven selling, and I think it does matter in the near term. I think gold itself is at long-term support, and I think the GDX probably violated long-term support. Those participants who are trend followers and who regard technical analysis as a good tool with regards to timing certainly would have become unnerved today with the GDX breaking through support. Fundamental investors probably have a different point of view, although I note that many fundamental investors, like myself, are increasingly intrigued by the high yield debt market rather than by the equity. So there may be some disintermediation out of equities into debt, even in the gold sector.
Okay, well, Rick, I'm going to leave it short this week. I know you have a busy schedule, and thank you so much for your comments as always, and thanks for coming back on the show. We'll talk to you again next month.
Thank you for your insightful questions, Colin. They're an unfortunate rarity in this day and age.
Thank you for that.
All right. Bye-bye.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?